Why are you not starting a business? One of the answers you are most likely to give is that you do not have the money, you do not have the capital to start a business. This shows us that we acknowledge the need to have capital, the need to have money, the need to have credit facilities so that we can be able to finance and start a business. It is also from this idea that we have what is called an accounting equation, and the accounting equation is basically the foundation of the subject accounting. Before we get to that, let us consider the person who is referred to as the father of accounting. His name was Luca Pacioli. He was an Italian mathematician and Franciscan monk. In the year 1494, he wrote a book he titled Summa di Arithmetica. In this book, Luca Pacioli proposed what we now refer to as the double entry system. The double entry system, it is a bookkeeping system which proposes that for every financial transaction, it is always going to affect at least two accounts. So the essence, the meaning of the double entry system is that every financial transaction affects at least two accounts. I'm going to be using this abbreviation A/C to refer to an account. Come to think of it, when we are talking about financial transactions, we are obviously concerned with the seller and also the buyer. So when the seller sells something to the buyer is going to be affected because he or she parties away with money. Then the seller is also affected because even though he sells something, he's going to receive money at the end of that deal. So the double entry system, a bookkeeping system, is telling us that every financial transaction affects at least two accounts. When we look at these accounts, we are going to have what we are going to refer to as the debit account and also what we are going to refer to as the credit account. But we are going to learn this as and when it becomes necessary. The reasons for the double entry account is that the books should always balance. That is the reason for this double entry system. Looking at the double entry system and the contributions of Luca Pacioli to the body politic of knowledge, there's something we come about, and that thing is referred to as the accounting equation. So Luca Pacioli's double entry system takes us to what is referred to as the accounting equation. So this is going to be the subject of this lesson. We are going to learn about the accounting equation. When we refer to the accounting equation, simply put, it is assets are equal to equity plus liabilities. So this small equation is the accounting equation which forms the foundation of this science we are learning, the subject of accounting. So what are assets? We should be able to define assets, and we are really going to use a limited definition which is going to serve the purpose of giving us an idea of what an asset is. So when we talk about an asset, we are referring to what the business owns. So an asset refers to that which the business owns. What about liability? So before we discuss what the business owns, remember the question I asked before we began this lesson. The question was, why are you not opening a business? And your answer was, I do not have the money to open a business. Then we realized the importance of money and capital and also credit in the financing of a business. Looking at that, we now have assets. Your business has assets. The question is, where did these assets come from? The main two sources of assets are going to be the owners of the business and then the lenders who lent their money to the business. So when we say assets equate equity plus liabilities, equity and liabilities refers to the source of financing. So when we say equity, we are referring to the owner's claim to the assets. We say the owner's claim, or say contribution to the assets. We have assets, the things which belong to the business. Where did they come from? They are not manna, they did not fall from heaven. They came from somewhere. The first source of financing the business or of contributing the assets are the owners of the business. So equity is the owner's claim to the assets, or simply put, equity is the contribution of the owner to the assets. Let us now talk about liabilities. The second source of financing. Liabilities, we are referring to what the business owes. What the business owes. So please do not confuse these two words. This one is owns, in the sense of being the owner of something. So assets are what the business owns. But when we talk about liabilities, this is what the business owes. That is what the business owes to the lenders. We can also define liabilities as the lender's claim to the asset. So the lender's claim to the assets. That is also another way of defining liabilities. So the accounting equation, which is a birth child of the double entry system of bookkeeping, as developed by Luca Pacioli in his Summa di Arithmetica, is what we are going to be concerned with. This is the foundation of the subject and study of accounting. Now let us double down on the accounting system or the accounting equation. We have defined it as assets being equal to equity plus liability or liabilities. And we now know what assets are: that which belongs to the business, equity, the contribution of the owners to the assets, and liabilities, the contribution of the lenders to the assets. To better understand the accounting equation, we are going to go through certain cases, starting with case number 1. So when we introduce case number 1, the reason of it is to teach us how to do the recording part, because in accounting we have to have a record of financial transactions. But I want you to also remember that financial transactions are going to be affecting two parties all the time. So whenever we are recording a financial transaction, we have to expect its effect to be felt by two parties, typically the buyer and also the seller. But that is not always the case. The two parties can take different forms, but they are always two parties. So what is going to be our case number 1? For our case number 1, we do not have a business yet. Then the owner decides to start a business. So this case is telling us that the owner decides to start a business. And we are also told that this business is going to be a bookstore where he or she sells books. But when the owner decides to start the business, of course, you do not start a business without money. Remember, money is the number one resource required to start a business. The owner then contributes $1,000, and this $1,000 he or she deposits into a bank or in the bank. So this is our case. We want to learn how to record it. The owner decides to start a bookstore. The owner then contributes, maybe he or she was saving up this $1,000. Then she or he contributes the $1,000 to the beginning of the business, but does so by depositing it into a bank. The question we are going to ask ourselves, this is the question: is the owner poorer? Because of this decision, does the owner becomes poorer? That is the question we ask. And the answer is going to be no. The reason why the owner is not poorer because she or he parted away, because she or he parted with this $1,000, it is because the $1,000 is still yes or is, even though it is in a bank account. And this bank account, of course, belongs to the business. So we have the owner opening a business account with the bank, then deposits $1,000 into it. The owner is not poorer after this decision, because if he or she decides at any point to go and withdraw that $1,000, it is his or her prerogative. So the owner is not poorer. That is a very important question, and you are going to sense its importance as we learn this subject. Now with this case, how are we going to record it? Keeping in mind that this transaction, it's actually a transaction, taking his or her 1,000 from under his mattress, for example, depositing it into a business bank account. There's a transaction between the bank and the owner. How are we going to record this transaction? So in order for us to record this transaction, we are going to incorporate the accounting equation, but I'm going to only write letters. We already know that A represents assets, E represents equity, and L represents liabilities. What has happened? The owner took $1,000 and deposited it into a bank. What has increased, or rather, what has been given to the business? The business has received assets. So to the business, it is going to be $1,000 as assets, and we just specify that it is in the bank. So going with $1,000 to the bank, you have added to the assets of a business. And since we are just opening this bookstore, maybe this $1,000 is the initial investment into this business. But what else has happened? Remember what E represents. We said that E represents the claim of owner to assets. And we also insisted that the word claim actually represents or means contribution. So equity, that is the contribution of the owner of the business to the assets of the business. So when the owner deposited $1,000 into the bank, the owner should also record that there is an injection of $1,000 as equity. And true to what we said, you can see that it's a double entry, and there is also a balance. 1,000 under assets is equal to 1,000 under equity plus 0 under liability. So our accounting equation is balanced because of the double entry system. Can you see what is happening here? The owner taking 1,000 to a bank, that is equity because that is a contribution from the owner to the assets of a business. But this 1,000, it's not new money. The 1,000 is not new money. It is just telling us that this 1,000 we have as assets in our business has been contributed by the owners of the business. So the business does not have $2,000. The business only has 1,000. But the accounting equation is telling us that the 1,000 we see as assets has come from the equity, has come from the owners of the business as equity. So equity is telling us who provided the funds, which is the owner. And we should also learn about a new word, which is capital. But before we go there, let us stress this out, that equity So what happens is we do not expect miracle money here. When we see money as assets in a business, we need to know where that money came from. And if it is recorded under equity, we know automatically that it has been contributed by the owner. Now, the $1,000 is regarded to as capital. But we have to be careful about this word capital. The way we define it, we say capital is the section of equity that came about because of a direct contribution by the owner. So when we talk about capital, this is a direct contribution from the owner to the assets of a business. You might be asking, but we said equity represents the claims of the owner to the assets of a business. Why then do we single out capital as a section of equity that came about because of a direct contribution by the owner? It's going to be apparent as we learn why we have to single out capital, so you just have to be patient with us. The owner contributes assets, the owner contributes resources. So this was our case number 1. I hope you understood, especially the part of double entry, the part of entering the 1,000 as an asset and also entering the 1,000 as equity. We also want to introduce a case number 2, which is going to add to what we have learned. But the reminder is there should be a double entry because every financial transaction affects 2 parties. Case number 2. So case number 2 follows after case number 1. So we already have recorded what has happened in case number 1. We are taking that recording to case number 2. In case number 2, the owner discovers or the owner decides that $1,000 is not enough to run a bookstore. I need more money, I need more financing. So what does the owner do? The owner looks for credit facilities, maybe goes to the bank, which is, I think, in my view, the primary lender when it comes to businesses, and negotiates a loan from the bank. So for case number 2, we are saying the owner borrows another 1,000 from the bank. That is what the owner does, borrows 1,000 from the bank. But the owner is borrowing this 1,000 in their personal capacity. So they are doing so in their personal capacity, but they are not even going to take a cent from it. They have physical or financial discipline to take the full 1,000 and invest it back into the business. So what happens now is the owner takes the 1,000 and invest it. How does he do so? By depositing it into the business account of a bank. So the owner takes this 1,000 and deposits it into a bank. We want to record this. But as we record this, we should know that we are continuing from our case number 1. So what has happened in case number 1? In case number 1, we had assets. So let me do this. Of course, assets are equal to equity plus liabilities. And from case number 1. So to make it different, I'm going to use a different color for case number 1. Then I continue with white for case number 2. So in case number 1, we saw that there was an increase in assets by 1,000 and this was deposited into a bank. We also saw that we are going to record 1,000 for equity because this 1,000 is coming from the owners. Now when it comes to case number 2, we are going to record or add 1,000 which is also deposited in the bank. But we ask the question, where did this 1,000 come from? This 1,000 came from lenders who has a claim over this 1,000. The person who has a claim over the 1,000 is the bank or the lender. So here it's going to be $1,000. And when we say the bank has a claim, we mean as the owner, we have an obligation to pay back. So this is very important. We should always acknowledge that the owner has an obligation to pay back. That is why we record it under liabilities. So if we want to sum everything up, our current position is for assets being equal to equity plus liabilities. We now have 1,000 plus 1,000, which is $2,000. Where did it come from? We have 1,000 contributed from equity. We have another 1,000 contributed from liabilities. So this is the story of our business. We currently have $2,000 in assets, but where did we receive it from? 1,000 from us, the owners. Another 1,000 we borrowed it from lenders. What is going to happen now is, in our next lesson, we are going to have a case number 3, number 4, and lastly, number 5. For case number 3, we are going to look at a business purchasing inventory. We define inventory as something the business buys with an intention to resell. So since our business is a bookstore, we have to buy the books so that we can sell them. But after we have bought the books, what has happened to the financial position of the business? And we are also going to have some recording we do on the accounting equation. For our case number 4, we are now going to see what happens when the business has sold the books it bought and made a profit. How are we going to record this profit? Then for our last case, which introduces us to an accounting equation, we are going to see when the owners take the profit to their personal use. How are we going to record this? Thank you for bearing with us. I hope you learned something new. If you have any questions or contributions, please don't hesitate to communicate them under the comments. And if you enjoyed the lesson, may you please consider subscribing to our channel so that other folk who are looking for material in accounting may also benefit. Thank you.